$1 million retail property versus $1 million office space. Which one's the best for you to invest in right now in this current market with the highest returns and the best value for money, but also what will give you the best capital gains in the next 2 years? So join me for this video as I take you through different case studies, different options, and showing you what you're going to get in terms of cash in your pockets, as in passive income from day one after you invest in these properties. My name is Helen Tarrant. I help everyday Australians become wealthy through investing in commercial property, building them out a portfolio, but the most important thing is to have cash flow, growth, and uplift in your portfolio. And here with myself and the Unikorn team, we can help you achieve that in the next 5 to 7 years. If you want to find out more, click the link below, join one of our events, or book in for that free strategy call. Let's get started. Now, you might be thinking, no, I don't want to invest in anything but a warehouse property. However, what we've seen in the last 4 years is that warehouse properties have actually boomed in the last 4 years, and they are continuing to boom, but at a much smaller scale compared to where they were 4 years ago. So if you haven't invested in a warehouse industrial property, maybe this is the time for you to consider an alternative asset to invest in, an office space, a retail space. Now, of course, these properties are tenant dependent, just like your warehouse properties. A different tenant can be in a warehouse property, for example, it can be a community service tenant that helps people do workshops versus a pure logistic tenant or perhaps a trade tenant. So in retail and office space, they're exactly the same. In retail, for example, you could have a cafe, restaurant, a dental clinic, a government agency, a H&R Block, which loves the ground floor area, but those are all retail properties. So what classifies as retail properties is ground floor, glass front, direct access to the public. Often you'll have, they may not have any stairs. It's got that lovely little ramp that is the disability, gives you good disability access. That's what really defines a traditional retail premise. But also in each state, there is classifications of what kind of tenant fits into a retail space and is considered retail tenants. For example, a hairdresser is classically a retail tenant because they operate out of a retail shop front most of the time. But whereas if you had a specialist clinic, a lot of them are actually in high-rise office spaces that are zoned medical, maybe across from a hospital. So they're not actually retail tenants, but more of your professional office space type tenants. So in office spaces, you can have lawyers, doctors, you could have cosmetic surgeons, you can even have now childcare centers in the second level of often big office buildings, and they're still considered kind of office tenants. A lot of medical centers are going to the second floor. So now the versatility of office spaces is far and beyond what it used to be 10 years ago. But let's consider some examples because numbers do talk in this game that is commercial property. So let's have a look what it is right now, but I'm going to give you some foundation tips to start with. And if you listen to the rest of the video, I'm going to share with you where is the best area to buy in right now for commercial property for either retail or office space. Now, let's get into what a retail space looks like and what your options are in this market if you've got $1 million to spend. If you're buying retail and you want something freestanding for $1 million, the only place you're probably going to get that is probably Melbourne right now. Now, Melbourne fringe, not in the CBD, but the fringe suburbs, you are going to get them. They are going to be really small. So most of the time, they're probably on 100 to 120, maybe a maximum 200 square meters of land, squashed in between lots of other shop top housing. You might get shop top housing, which means you might get a apartment above that used to be the caretaker's residence and they used to operate below. You might get that in closer to the city, but further out, most of the time what you're going to get is long, narrow strips of land. Front of it, you're going to get a shop front. At the back, you may get a residential tenancy, which may be able to be converted to commercial later on. Now, however, the downside of that is that the return, which is called a yield in commercial property, is very, very low when you're buying this type of properties that are freestanding in Melbourne. Now, these yields are likely to come in around that 5% mark. At best, you're probably doing 5.5, but most of the time it's going to be sitting somewhere at that 5 to 5.5% mark if you're buying a freestanding retail. Now, the reason is that Melbourne's one of the few metro cities out there that right now you can still get a freestanding, as in not on a strata, you own the land and the building, in around $1 million. Whereas in Sydney, if you want something like that, you're starting at 3 to 4 million. In Brisbane, you're minimum high 2 mil to mid 3 mils to buy a freestanding property, right? So that's why it makes Melbourne so popular, but it drives the prices down, right? So you've got to think about it. Now, with that, what you're trading is you're trading the price and the returns, but you're getting freestanding land. Well, is that worth it? Well, let's look at some other options. If you were to go to, say, for example, now you want to go to Sydney or Brisbane or anywhere that you think you could do better with $1 million and get better returns, most of the other cities are going to be strata properties. So what does that mean? It means it's going to be units above and you're going to be the strata shopfront down below. They might have 6, 8 strata shops when they might have 25, 50 apartments above. Now, recently, in the last few months, we settled on a property for our clients in the inner city suburbs of Woolai Creek. And that property was a vet in there that's been established and already their second practice. So that vet is quite established and well known in the area, and it services all the apartment pets in that area, which is high density apartments. That was about $1 million, and the return was about close to 6%. Yeah, give it a 5.75 or so. 5.75 after you clear all the expenses. So, and will be 6% in the next 12 months with a rental increase. Now, that kind of property is typically what you will get in a metro area. If you're in Brisbane, you're going to get similar results. Maybe the premise will be a little bit bigger. This one in Sydney is about 119 square meters. Maybe you get 130 in Brisbane, depending on what area you're buying in. But the returns in Brisbane is probably going to sit about that 6% mark versus Sydney a little bit lower than 6% in retail. So you are going to get almost 1% more by buying a property that's part of a strata rather than a freestanding in Melbourne. How does these numbers work when you look at these options? Now let's look at it. If you're borrowing $1 million, you're borrowing roughly about 70%. Now 70% you can still use the lease to service the debt or the loan. So it's not reliant on you. At 70% you can still get lease stock loans. Normally it's 65%, but the bank can push it up to 70%. And if you're doing it yourself as a full documentation loan or through your business, many ways of financing commercial property, you can still get up to 70%. So that makes it really, really simple for you to just borrow up to 70%, 30% in terms of deposit, and allowing 5% in terms of cost. Allow a little bit more if you're in Melbourne because the stamp duty is about 5.5%. So you need to allow about 7% in terms of purchasing costs to allow for, your pest and building inspections, your solicitor costs, not your buyer's agency fees, but all of those other fees, right? Now, if you're in any other state, 5% roughly is enough, give or take, 5 to 6%, because the stamp duty sits somewhere around 4 to 4.5% and allows you for stamp duty and some valuation fees. So now that means you need to have $300,000 in hand as a deposit plus 5% cost of the purchase price of the property, so $50,000. So $350K, you're borrowing $700,000, right? And the current interest rate is about 6.75 on the lease stock loans, or loans that are maybe, if you go up to 70, you may be offered a fixed rate. But let's work on 6.75%. 6.75% on $700,000 of borrowing works out to be $47,250 in terms of interest. Now, when you get that, you're going to wonder, how am I going to service it? Luckily, in commercial property, all the rents are net rents, which means that the tenant gives you the lump sum payment of the rent. So let's call it $55,000 if it's 5.5% yield on the $1 million. And that's $55,000 that comes directly into your pockets. You don't have to pay any additional costs out of that $50,000. So you don't have to pay management fees, land tax, rates, insurance, all of those things are taken care of by your tenants. So $55,000 is pure net rent coming into your pockets. Now remember, your interest is $47,250. Now that means that out of your $50,000, you need to take out $47,250, and what you have left is a magic surplus of $7,750. That's if you buy a freestanding little patch of land, freestanding, potentially with a house, a shop top housing on top, plus or a residence at the back, plus at the front you have at the front, you have a commercial property. Now, and that's yielding 5.5%. So you're going to clear on that property $7,750 in positive cash flow. Now, that's if you buy Melbourne right now. If you like the previous vet that I was talking about, or it's another retail space in Brisbane, so in Sydney or Brisbane, you want to go somewhere else and get a higher return, let's say 6%. You're trying to get 6% return right now in Brisbane, then you're going to be clearing $60,000 coming into your bank account on a yearly basis. So that's going to be broken up on a monthly basis, obviously, with the rent. But altogether, you get $60,000 pure net rent coming into your bank account for the year. And remember, your interest is $47,250. So you're going to clear $12,750. So you're $5,000 ahead than if you had bought a property at 5.5%. So buying a 6% yielding property versus a 5.5% yielding property gives you an extra $5,000 in your pockets, right? So then let's look at what if you want to go to the extra risk. What if you want to go to the extreme, right? And say, well, I just want to spend $1 million and I want to go regional and I want to buy a retail property in regional. I want to get $70,000 in net rent coming into my pockets, right? So $70,000, remember, tenants pay all the outgoings, rates, insurance, land tax, management fees, they pay all of that in pocket, you get $70,000. What's your interest? Still $47,250, hasn't changed. The bank doesn't care which metro city you buy in. The interest is the interest, and you're still going to get the same amount of interest payments that you need to do per year, which is $47,250. So $70,000 minus $47,250 gives you a whopping $22,750. So $15,000 more than had you bought in a metro area. However, what you're sacrificing by buying in regional versus in metro is the capital growth. If you want more capital growth, you need to stay in your metro areas where you're probably going to get somewhere up to about 2% more than you would in regional areas. So if regional areas is doing, let's say, 4 to 6%, you're likely to get somewhere around 6 to 8% in the metro area. And ultimately, if you're young, trying to grow your portfolio, your growth is going to be more important than your cash flow, but you love to have some cash flow to help you service your other debts, then buying in metro area around 6% is really what you need to hit, right? And that's for a property that is retail in any of the metro cities. Now, let's consider what if you wanted to buy an office space. Now, I know there's so many naysayers and bad press about buying an office space, but what recently we've been able to pick up for our clients is really high return office spaces in metro areas. So for example, you could buy an office space in Melbourne, and Melbourne is probably one of the few places that you can get a office space in fringe areas where it gives you 6.5 to maybe 7% in net yield, as in net return in your pockets, right? Now, you can get something similar in Brisbane. You can also get something similar in Sydney, but the Sydney returns on office spaces is lower compared to Brisbane and Melbourne. So if you want something in other than Melbourne, because you're feeling Melbourne's just not secure and there's no confidence in office spaces coming back, you might want to consider Brisbane or Sydney, right? But if in Melbourne you could get 6.5%, remember, you're paying the bank exactly the same interest, right? The bank doesn't care if you're buying an office space, a retail space, or a warehouse space in Melbourne, Sydney, or Brisbane. The reason they don't care is because they're going to charge you the same in interest, right? All they're interested in is, are you going to be able to pay me back? Is this property you're buying reliable enough with a reliable tenant to be able to pay me back my interest to you, right? So what you need to prove in the application is that you do, right? And so that what they're doing is assessing the property. Now, here at Unikorn Commercial Property, the specialist buyers agency that I run here in Australia, I help educate everyday Australians on how to invest in commercial property, then help them implement it through my buyers agency. And we've grown exponentially in the last 4 years to now have like over 7 buyers agents that work with us. But one of the things that we haven't grown massively to 20 or 25 people is because I like really knowledgeable, in-depth buyers agents that work with us. All of our buyers agents are investors in commercial property themselves, not only one, but many commercial properties, and they've done syndicated deals with us, they've done uplift deals with us. They are knowledgeable on their own, and they're also got semi-passive income already. Like, so they could semi-retire, and they're doing this because they love commercial property so much. And that's what makes it so different here at Unikorn, is you're dealing with experienced people who can handhold you and mentor you and guide you through investing the right commercial property, especially if it's your first one and you're building out the portfolio. Plus, I oversee all of the deals here in Unikorn Commercial Property, because I want to make sure that you are buying the right deals and that your investments is not only going to help you buy this month, but the ones to come. So when you're choosing investments, we don't only just do Sydney, Melbourne, Brisbane, we do all across Australia. But one of the key things that most people miss, most buyers agency miss, is the comparison. They don't compare different states to see which one's going to give you the best value for money, right? And so that's why we're so different here. We often compare all the properties across Australia to find the best value for money for you right now in this current market. So if we come back to the office space right now and we're looking at where is the best place to buy, I have to actually honestly say Melbourne it is. If you can get into the ACT, that's great, and then follow on by Brisbane. So Melbourne, ACT, and Brisbane are my three key areas I like to invest in when you're looking at office space. One, because Melbourne at around that $1 million, what I'm trying to seek is a large space where it's either a whole floor or half a floor, right? And because Melbourne market has been smashed, you can actually pick up half a floor or a whole floor of office space where it becomes versatile for you to later on cut it up and create an uplift in the future. So you don't have to do it now while you have a tenant in place, but you could pick up a really great return with the current tenant. Think about it, 6.5% to 7% return means that in pocket, remember, the bank charges you the same interest no matter what returns you get from the property, right? So if you got 6.5% to 7% return in a metro area, it's like having your regional returns, but in metro, and later on you're going to have that capital growth. So you're having your cake and eating it too, right? Because if you had a 6.5% yielding property on $1 million and you bought, let's say, half a floor, let's say it's 150 square meters or 200 square meters of office space in Melbourne, but not Melbourne City, but Melbourne CBD, but further out, you're going to have, $17,750 in positive cash flow after you pay all the expenses and the bank, right? That's $17,250 going into your pockets every year from that property. And then you wait for the capital growth to kick in the next 24 months. You refinance, not using your own money or increases in your own paycheck, but you're using the cash flow from that property to refinance and go again. So you can recycle your deposit and go again so that you can buy bigger and more commercial properties, right? So you can retire sooner or passive income, because that's what it's all about. So right now, like this prime example of a property, this property here is in Docklands, but there's also we also did one recently in Kingsway for a client, all around that $1 million mark, where it's a half a floor or a whole floor, where you're able to then later on split it up into multiple, so 2 or 3 office spaces. And these properties are all trending between 6.5% to 7%, right? And I know people talk about how certain areas in Melbourne aren't the greatest areas to invest in, but you've got to look long term. You can't just look to 12 months, you've got to look 24, 48 months ahead and say, where's my biggest gains? Can I recycle my deposit? If I can recycle my deposit and help me go again, then that's the magic I'm looking for. So let's do the numbers. If you're buying $1 million office space right now in Melbourne, Brisbane, or Sydney, and you need to look for a property that is not like 60 square meters. You need to look for a property that's over 100 square meters, maybe 130, 150, even 200 square meters. The reason for that is you want the tenant to be in there now for the next 2 to 3 years. So all it needs to do is have a lease of 2 to 3 years. If it has 2 to 3 years, it'll bypass what's happening in this market, give you that security until the market changes, the interest rate drops, and then allow you to then refurbish the property. Because if the current tenant did leave, you could cut that property into much smaller spaces. A 150 square meter space can be 3 50 square meter offices, 2 75 square meter offices. Now, in fact, one of the biggest trends out there is this sharing of boardrooms and common kitchens. So if you could put in a common kitchen and a boardroom in the middle, and that might take, let's say, 10 square meters out of it, you could cut up the other spaces into smaller spaces and charge them more. So instead of them being 75 square meters, you cut them into 40, 30 square meter spaces and charge a premium 20% compared to what other people are charging in the market to recoup the cost of that lost space, but also to bring more cash flow into your pockets, right? And that's the magic of what you can do to uplift a office space versus anything else at the moment in this market that most people are missing. So that's why the larger floor plates work for temporarily now, but in the future, allowing you to give you that uplift. However, the great thing to look at right now is while the interest is high, you're borrowing 70% against $1 million And remember, your interest is $47,250. If you're getting $70,000 in net rent from investing in an office space in metro area, then you're clearing $22,750. $22,750 for the next 2 to 3 years until maybe the tenant moves out. Then you can do a full refurbishment, maybe uplift that to like $80,000 in net rent. Or $90,000, depending on how you fit it out and how beautiful and the location of the property. So all of a sudden, you might be able to, in 3 years, make almost 40 to 50 grand passive income of that one property that you bought for $1 million. And that's where the hidden gems are in the market, the hidden opportunities that people are missing out on. So that's why here at Unikorn Commercial Property, we not only look at what's in the market, but we think outside the box of what you could do as a potential of this property. And we look at what clients need, and we actually create a blueprint for you to get to your financial freedom figure, whether that's 50, 100, or 150,000 in retirement, to help you get there step by step through our Unikorn system. So remember, whether you're going to buy an office space or a retail space, the most important thing is to do your numbers. Do you want a freestanding retail space, which is going to be about 5.5% yield? Or could you go for an office space where you might get half an office space or a full office space where later on you cut it up, but right now you get instant cash flow of $22,750? Because remember, the cash flow at the moment may help you sustain other properties in your portfolio so that you could get more wealth in the future by keeping these properties rather than having to sell them, because you have so much more cash flow coming from just that one property. So right now, what is my pick if you're buying office or retail is that if you can get over your fear of investing in an office space, buy an office space with a good tenant in there that has a lease for the next 2 to 3 years. The tenant has established history. The area is changing and gentrifying. There is the building itself or the area itself has very low vacancies. Invest in that property. Buy something with larger floor plates in 2 to 3 years' time. When the tenant leaves, if they leave, if they don't leave, they stay on. You get both the cash flow and the growth. Fantastic. If they do leave, you make it smaller, make the office space smaller, charge a premium for that small space, increase your returns in cash flow, and increase the growth of that property, refinancing so you can buy again. So really, my tip right now is, if I was you with $1 million, I would buy an office space right now in a metro area. It doesn't have to be Melbourne, Sydney, Melbourne, Brisbane. That's where the areas I would choose. I would also consider ACT as a good, solid investment because they're mostly backed by the government, but I would stay away from Perth, Adelaide, and Tassie for office spaces about $1 million. If you're buying smaller office spaces, you consider those areas, but around $1 million where I can get real substantial value in Brisbane and Melbourne especially, then I'm going to consider those two cities instead. So I hope this video has been informative and it helped you make a decision whether you should be investing in an office or a retail space. If you like the video, hit the subscribe button, share it around, but click below to book in for your free strategy course and let me and my team here at Unikorn help you build a cash flow rich portfolio through commercial property and help you retire in the next 5 to 7 years. If you love this video, make sure you hit the bell and subscribe. I'll see you in the next video. Bye for now.